This episode is brought to you by Fiscal AI. Monetary Matters listeners can get a discount to this charting and research tool. Max and I use it, and almost all of the charts that you're about to see in this episode are made with Fiscal. Joined by my friend and business partner, Max Wiethe of Other People's Money. Max, we're recording on Friday because it's the big job day. What was the job numbers from September, and what does it tell us? Start off.
Well, Jack, I don't know if you were paying attention this morning, but we didn't get the jobs numbers. With the government shutdown, NFP report was delayed. We got no jobs numbers today, and that left macro junkies like you and me clamoring, wondering what we are going to do with our day. Market didn't really have a major reaction to the lack of jobs numbers. This isn't actually even the first data point that was delayed. We kind of knew that this was coming because we had some other data that was supposed to come out yesterday that didn't come out. So we'll see how long the government shutdown lasts and whether it goes all the way through Fed Day, whether the Fed is going to be privileged to this labor data that is obviously hugely important to their decision around the rate cutting cycle, which kicked off at their last meeting. So what do you make of that, Jack?
It is pretty strange that the government shut down and the market didn't really budge at all. I think the market's looking through it. I do think, Max, we're going to be talking about gold and silver later on in the show. And, I think we've both been pretty bullish on gold, and I've been expressing that in various ways. But I think that it is almost, I would be shocked, Max, if when the government shutdown ends eventually, that gold is going to take a 1 day correction that could be quite steep. Returning to the values not seen since a few days ago. But yeah, I think that gold's getting quite overheated. Max, I just think that I want to step back and look at the stock market, what's working and what isn't. I think that the real durable theme, Max, that I believe in and have been a believer in is just the build out of artificial intelligence. So capital expenditures on next generation data centers, and that, Max, just is extremely robust and continues to be so. We're seeing in the market like semiconductor stocks and other stocks that attend to data centers. They are rallying like crazy, but also, Max, we've just seen some deals. I mean, today BlackRock is announcing plans to buy a data center complex for $40 billion. The other day, Microsoft elaborated upon its $19 billion deals with Nebius, a neo cloud provider, and they've actually inked $33 billion of deals, a $33 billion bet on other neo cloud providers that basically own and borrow NVIDIA GPUs and then rent them out. We've talked about, I believe, earlier about Mark Zuckerberg of Meta, his quote that we may waste $100 billion, we may waste, and the fact that the captains of industry of tech and AI are saying, this is a bubble, but this is a good bubble, and we're diving headfirst into this bubble. And I don't think that this is when you hear that, there's two ways to interpret that. There's number one, oh my God, they're saying it's a bubble. We sell short. And number two, of this party is kind of just getting started. And Jeff Bezos, obviously founder and former CEO of Amazon, said today to the Financial Times, this is a good bubble. And that's the exact quote, saying this is not a financial bubble, it's an industrial bubble. And the phrase industrial bubble suggests that there are real fundamentals there. So I was looking at NVIDIA NVIDIA net income expectations, profit expectations for next year and then the year after. And then the median for the year after, for 2026, so NVIDIA fiscal 2027 is $154 billion. I think, a lot of smart people, Max, who I talk to, think that number's too low. The next year, so fiscal 2028, but actual year 2027, it's 182 billion. Again, a lot of people I talk to think that number is going to be higher. So it's possible that the biggest bubble ever, the expectations are just not rosy enough. And I remain long the AI capex space, and I would advise against shorting it at this juncture. And anyone who has been shorted it must be quite painful. And so, Max, I am I'd say I am a believer in this bull market that we have here, at least in the US as well as in China. Europe, I'm not as familiar with, to be honest. But I think every single sector in the S&P 500 is up year to date on a total return basis. The number one is technology, which, let me just find my numbers, is technology max is up 23%. Communication services is up 21%. Utilities is up 18%. So people might look at that and say, oh, utilities is sending a risk off message like it did in 2022. No, 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 no. You dig into the utilities, and what are the stocks, utility stocks that are rallying the most? Independent power producers that, like Constellation, or Vistra, that are supplying all of this energy to the data centers, that and they're going to charge a pretty penny for it, and make a very high profit margin on that. So it's not at all a risk off metric, a sign, I don't think at all. And Max, what is the worst performing sector? Consumer staples, which is the other risk off sentiment. That's up only 1%, but that's actually because of dividends. So in price basis, year to date, that's actually down 70 basis points. So I think this is a bull market, Max, and I think that that's going to continue for at least some time.
Yeah, well, I think with these bubbles, obviously, when you think back to the tech bubble of the early 2000s, I mean, it did take 6 years to recover from to recover back to the highs. I believe that we saw there. I mean, it can take a lot of time if you find yourself on the wrong end of it when it deflates. The question is when and how do you recognize that? So I think the biggest thing is to just not like believe your own bullshit, so to speak, on some of these like bubble things. Like recognize it's like, yeah, this is highly speculative. This is an arms race in many ways between these big tech companies who view it as potentially existential if they do not enter into this, and they're going to continue doing it until somebody bluffs. And there is going to be the first mover, thinking to margin call. You can be the smartest one, or you can be first. And I've never been the smartest one, so I prefer to be first. And I think there will be obviously one of those big tech leaders who prefers to be first and cuts back on this once it becomes clear that they're spending too much. But in the meantime, or we could all be proven wrong and they're right, and this is not a bubble at all. So we'll wait and see. But as of right now, I don't see anybody bluffing or blinking their eyes, and I don't necessarily think that as an individual investor, you need to be first here.
Yeah, and actually, Max, I think that the risk is that the fundamentals, and this is going to sound ridiculous, but that the fundamentals are simply too good. If the data center capex was only growing at 10 to 20% per year, that people wouldn't get too crazy, the stock market wouldn't get too crazy, and this thing could last for like 5 to 10 years. But the amount of money being spent right now is just so large that I don't know how these earnings of these companies are going to go up by 30 to 40 to 50%. Like that is what I think is maybe unsustainable. And I'll also say, Max, like I don't take pride in my ability to be right, but I take pride in my ability to change my mind. So I've been very vocal on this channel, and I've done so many mea culpas about I was too bearish, like many people in the market, but I was too bearish around April with the uh, Trump tariffs and Liberation Day, and so I've openly diagnosed myself as having that month tariff derangement syndrome. And for a few days it was you were making money being bearish, but then you were losing money to be bearish, and being bearish you've just lost you money since about April 9th, when the Trump truth heard around the world about now is a good time to buy stocks, and then the 90-day pauses and delays that we're still in those delays. But I've changed my mind, about in that spring, and I've been getting more bullishly positioned and more bullishly positioned. And I changed my mind. So, we could Max record something next week and I could totally change my mind. So I don't, I ask people to, if they're going to evaluate my calls, do it so on a rolling basis. And in a year, people would say, "Well, Jack, in October 3rd, you said this, and the market's crashed since then." It's well, was I what did I continue to change my view? And I also say, Max, I'm confident in like what I own and my sort of themes of so semiconductors and AI capex, China, Chinese fintech, and precious metal streamers. There's a lot that's rallying in the market that I don't have confidence in, and like a lot of themes are something that I definitely would not want to be positioned long at all, like quantum computing or crypto treasury companies. That I think is highly speculative, and I expect that the long term returns of that will not be good for investors. But then again, it could rally another 50% over the next month, Max.
Yeah. So what about some of the comparisons that we're seeing between now and, there's a lot of comparisons between back to the 2000 tech bubble, but there's also comparison back to a more recent bubble, which was the sort of speculative shitco boom of 2021. Um, what do you think of those comparisons, and what are the signs that you think are like similar, and also the things that are completely different this time around?
Well, Max, you and I were bearing witness to the huge bubble of 2021, and we both were, quite skeptical throughout 2021. And I am of the view that what we're seeing now is very speculative, and there is a speculative fervor there, no doubt. But I think the speculative fervor is less, and the justification for the fervor is way more. I think the macro in 2021 was quite favorable because we came out of a depression in March and April 2020. So the earnings were going up. But in terms of themes, okay, electric vehicles, crypto, there really wasn't that much there yet. I think, in terms of valuation, crypto has done very well, of course, with the huge, collapse in 2022. But of the fundamentals, like has it changed society? I would say no. Electric vehicles, they have adopted rapidly, but way less so than the very, very rosy expectations of 5 years ago. I think that AI is basically a much bigger deal than both of those things combined, like a lot. And then also, Max, for example, like and I tweeted about this the other day in 2021, this kind of typified the ridiculous bullishness of the time. There was a woman who, I'm sure she had a big job at some company. She quoted this. We'll put this on screen. If you make an NFT of a real diamond and the diamond itself gets destroyed in a fire tomorrow, you still have the same asset because the token still exists and is in limited supply just as before. Nothing has changed. What NFTs are doing to the concept of an asset, few understand. So in 2021, people were saying that if you make an NFT of a real diamond and you destroy the diamond, that the NFT is still valuable. So they were making metaphysical claims about you could just basically create value from nothing. I'm not seeing that, Max, outside of maybe quantum computing, Bitcoin Treasury, and I mean, there's a lot of speculative stuff going on, but I don't think we're there yet in terms of uh, stock market fervor. In terms of capital expenditure to GDP, that's a different story. But I want to pause, Max. What is your view on this compared to 2021?
Well, I like to look at the SPACs and the new issuance. I thought the new issuance that we got in that period and sort of the crappiness of it was really the hallmark of the bubble, and arguably when that sort of exhausted itself, that was the top in everything. Just the supply in the bad companies eventually made it so that the money was spread around and there was enough weight from insider unlocks to sort of take things down. And I think what's different this time, and like crypto treasuries, I think typify this perfectly. Last time was a lot of companies that were fake companies pretending that they did something that was never going to happen. These companies aren't even like the SPACs this time, like they're not even pretending to be companies that they're not. Like they're just like, yeah, we're just gonna take your money and then we're gonna buy crypto with it, and then we're gonna issue debt and buy more crypto. They're not even pretending to make electric vehicle taxis. They're not pretending to have an electric vehicle that is going to make it to production that people are going to buy. Like they're just saying like, yeah, we're just going to play a financial engineering game and we're going to use this vehicle to do so. Which maybe you could argue makes it less, or makes it more speculative, but I tend to believe that it's about what the market believes to be true that isn't so. And I think everybody beside a few like firm believers in the like Sailorverse kind of understands that these crypto treasury companies like are financial engineering vehicles that don't necessarily make sense over the long run, unless you have like, there are some
Yeah.
unique cases, but um but beyond that, I think we kind of all understand what these things are. Whereas last time, like you would talk to people, I remember talking to some of our, like at Real Vision, some of the video producers, and one's like, oh, I'm invested in this electric vehicle company. And I was like, I know the former CFO of that company, and I can tell you that you should sell that. He has since moved on. He was in New York every week raising new capital. Like, you need to get out of this thing immediately. They are not going to do anything that they say they're going to do. Like that, I'm not having those conversations with people. People are just like, yeah, these crypto SPACs are going crazy. Like, I'm buying them because they're going up. Like, people aren't really believing in this story that's not true. And so I just haven't seen the really, really, really crappy fake companies coming to market yet that would lead me to believe that we are fully at the end. But each cycle is different.
Yes, I will say I did have an Uber driver who was telling me that he was day trading gold and silver, but he also said that he owned 20 apartments in a certain Caribbean island I won't name. So he must have been doing quite well. Max, your point is well taken that so many companies in 2021 that both of us in some form or other often shorted, like we're fake companies and frauds. I think you're saying that the crypto treasury companies are not even fakes. They're not even frauds because they're doing what they're saying they're doing. Basically, taking your money, buying crypto with it, and borrowing it and levering that to the hilt. They're not saying they're going to cure cancer with AI. They're not saying that they're going to build an autonomous robotic fleet. They're doing what they're saying. What they're doing is not very impressive to either of us, perhaps, but
Yeah.
they are doing it. I'll say, Max, probably three of my biggest short positions. Two of them I was right on the fundamentals. Three of them, only one of them made money. One of them, um, it was called Starry. It was basically retail bringing. It was broadband to internet to the retail folks. So basically, you can move away from Verizon, move away from T-Mobile doing this. They were losing they were losing hundreds of millions of dollars a year. And I remember Goldman Sachs put out a research report. They probably were an investment banking client, and they said this company is only trading at 10 times 2027 EBITDA. So there's a ton of nonsense about the future that is just not going to be so. And some people may say that, Jack, what you said about NVIDIA and the AI Capex is not going to happen. And you very much could be right. I could be wrong on that. But I shorted that company by the end of the year in 2022. It was bankrupt. Also, there was FaZe Clan, quite popular with kids, I understand, a video game network. It also was losing tons of money. I actually lost money shorting that, even though it was within a year of my shorting it, it was delisted, or it actually was acquired for like $1 or $2, which is basically the same as being delisted, if you ask me. And then the third company, I was wrong. It was QuantumScape. I've shorted it. It was a revenueless battery company. I don't think it still has really made any money at all in terms of even revenue, but the stock is still exists. And this is my thing. What I was right about the fundamentals that it would not do anything. It wasn't losing enough money. If you have $5 billion in the bank through issuing an IPO or a SPAC to unsuspecting retail, unsophisticated consumers or investors, like you have and you're only spending $200 million a year. That's like 25 years of runway there. And I think these quantum computing companies, I think, they're mostly fake. And I think I listened to Martin Shkreli, who knows way more about this than I do, and definitely, than I ever will, to be honest. But I think Martin's probably right that there's like commercialization is 20 to 30 years to wait for these things. But the only thing that I really understand is finance. And I look at the cash flow burn relative to how much cash they have on hand. And I don't see a catalyst of like these companies are going to go bankrupt at the end of the year. So for me to short, actually, I have shorted some of these companies, and I'll take take a taxable loss here, take a taxable loss there, which in a bull market can be very good. But I haven't like made a big conviction, a big short of these companies. And to make a high conviction short of these companies, I think they'd have to be losing a lot more. I think like the valuation would have to be higher, and they'd have to be spending a lot more. Um, uh,
So
yeah.
if you're not shorting what's going up, what are you buying that's going up?
I'm buying Chinese stocks, primarily Alibaba, as well as some Chinese fintechs, tickers of which I have mentioned in the past. I'm getting long the semiconductor industry, and how I express that trade. I won't really get into that. I've also been long precious metal streaming and royalty companies such as Franco Nevada, EMX, and more recently Wheaton Precious Metals. So that is something. Gold and silver has been absolutely nuts. And I think that we definitely could have a correction, but I think that the fundamentals for the gold and silver royalty companies are pretty good. And I think like these stocks, their value could go down 50%, in a short amount of time. But on the long term, I'm quite confident in these positions of basically they spend capital to receive a certain amount of gold and silver every single time the gold and silver is mined, and their capital contribution going forward is very, very low. So like gold mines, when the gold's going up, gold mining can be a good business, but you, like all kind of materials, including drilling for oil, you have to spend a lot of money to get it, and then you have to depreciate that over time. That can be tricky, especially when the price goes down. But I think these gold royalty companies, nothing is safe, but their their profitability percentage, is still quite high. So a lot of these companies have, EBITDA margins of north of 40 or 50%. Um, I mean, some instances, Franco Nevada, it's like ridiculously high, and I think that that can continue. But like I
What
said,
about
Max, I think go ahead.
I was going to say, what about silver? Because obviously, we have talked about gold. You're a follower of central banks. Central banks are buyers of gold. There's really no doubt that people in the world still see gold as a monetary metal, as a store of value. But silver is something that you and I have talked about as maybe kind of losing some of its monetarist value over time and becoming more of an industrial metal. I mean, if you think about it, like a central bank that's buying huge, huge amounts of gold, they've got these vaults that they have to fill them with. Like, if you've ever seen the difference between what $1 million of gold looks like and $1 million of silver, it's pretty clear why they buy gold and not silver. And obviously, we are not passing coins around anymore. So like the usage of silver for coinage to make it a monetary metal like doesn't necessarily make sense in the same way it did before. And so my question for you would be, when you think about precious metals beyond gold, um, what is it that would have you interested in silver and looking at a company like Wheaton Precious Metals?
Great question, Max. So I think the demonetization of silver is a trend that has been happening for about 150 years, when the U.S. and England moved from a bimetallic standard of gold and silver to only a gold standard. I think a lot of silver mining companies, based on like my reading of history, like Barry Eichengreen has written about this in his book Globalizing Capital, have the silver miners were not happy about that. So silver has gone out of favor as a monetary metal for 150 years, and I think that is continuing. Still, copper is almost only an industrial metal. Gold is almost, vast majority is a reserve asset or something people hold as a store of value, or jewelry. Obviously, there are industrial uses for gold, but it mostly is that. Silver is kind of in between. So it has these bipolar moves where it can go up because people want to store value and because gold is going up, also for its industrial value. The supply, Max, is also very interesting because a majority of the supply of silver and of silver production comes from the production of other minerals. So I think only about 25 to 30% of silver production is from mines that are silver mines. Most of it is from gold mines, copper mines, zinc mines, as well as recycling. There's a lot of recycling from industrial cases. But I was just because so and look, I don't want to pretend like I'm some person who's always known so much about silver. Like the reason I've been getting into silver is because the price has been going up and because I've been reading a few reports over the past week or so. So maybe me getting into silver and reading a report on silver is a top signal for silver itself. But we can flash on some charts, Max, just of the global supply. So mine production has actually been flat to down. It has been down over the past 10 years. Recycling of the production has gone up marginally. And when it comes to demand, there's jewelry, there's coin and net bar, photography, which is now a tiny amount, and silverware, and then industrial. Industrial is over half of the demand now, and industrial demand has been steadily growing. Max, I am not a technology specialist by any means, and I'm not an engineer. In fact, I'm the furthest from it. Maybe a financial engineer. I'm 10% a financial engineer, but 0% an actual engineer. And so I don't know this to be true other than from what I've read, but I think that the industrial use cases of silver are growing, and in particular, they have uses in chips and AI. Now, what I don't know is if the price of silver goes to $100, are these chip manufacturers, can they rely on copper or some other stuff in order to get around that? That's what I don't know, but I'm just looking at the supply and demand, and there is quite a shortage. Now, I think the way that the World Silver Institute or whatever published this report, the way that they report a deficit, they kind of fudge the numbers so that they're including as demand coin and bar demand. So there almost always is going to be a reported deficit unless it's like a 2011 year when there really was a true giant shortage. But I look at the supply and demand and I see, okay, there could be something here backing this up. I feel like for gold, it's primarily been Asian buyers, is my sense, Japan, but in particular China, and in India,
India.
but mostly the household sector and the household sector in China, but also the um, like institutional investors in China, such as the reserve managers of China for the government, and I think that is what driving it. Now, am I seeing their gold holdings go up so much? No, it's just that I'm seeing the price go up, and I know that U.S. investors are not very involved. You can see that by looking at the assets under management uh, of gold exchange traded products or ETFs, ETPs, as well as like the gold mining ETF, which is from a sponsor, Van Eck, but it is GDX or GDXJ. Like the AUM of that has actually, I don't know if it's gone down, but there have been net outflows of that. Like who would have thought, Max, that as the price of gold has doubled, the AUM, excuse me, investors would be pulling money out of gold exchange traded products and out of gold mining ETFs. That to me is interesting, and the same is actually true of silver. So look, I was definitely too young to be paying attention to it then, but of the silver bubble that we now know of 2011, there was huge inflows in the American market and into exchange traded products. We're not seeing that now. So am I saying, oh my God, gold's going to go to $80? No, I don't have any positions in silver, physical or exchange traded products. I do have a position in Wheaton Precious Metals that has roughly 30 to 40% of its what's it called royalties it gets from silver, and then Franco Nevada, which has a maybe a 10 to 15% of its royalties come from silver. So in the long term, I do have exposure to silver, but I'm not making any claims there. I'm just saying that I'm not seeing evidence that this thing is going to crash tomorrow. Also, Max, and I don't really trade futures or know that much about it. But when there was in GameStop in January of 2021, some of the people who got super long GameStop and made a bunch of money, mostly retail. Although I think the institutional people is kind of underrated there. Institutions made money long GameStop as well. But I think a lot of retail people, they got into silver. So like the price of silver briefly went to $30 for like a few days in February. Um, because silver was extremely volatile then. So actually, if you look at the Chicago Mercantile Exchange margin requirements, they required investors, traders really, to post a lot of collateral for their silver. Silver has not been that volatile. So the margin requirements for silver actually haven't been going up that much, other than the fact that the price of silver is going up. So you have to post more margin. But I think that the volatility profile of silver it's not like it's been going up 10% a day. It's been going up 2% every day. So I think it's slightly less volatile. So yeah, I don't hate the price of silver from here, even though it may appear overheated. Obviously, corrections are possible, but that's my view, and we'll link the silver report in the description.
Yeah, and when you're looking at the streamers, the royalty companies, um, what is it that you're looking at to determine which ones have the most percentage of silver?
Well, they tell you in the pie charts. We can put on screen from the Franco Nevada report. Gold is 70 to 80%, and silver's is less. Actually, I think gold's it's at 70%. Likewise for Wheaton Precious Metals, you can also just look at the ratio of the revenues that come from silver. So we can just put on screen that Wheaton Precious Metals, they actually used to get far more revenue from silver, but over time their revenues from gold have gone up while their revenues from silver have gone flat to down for two reasons. Number one, the price of the gold to silver ratio has gone up, and number two, I think it's the bigger reason, they've made a decision to diversify into gold. So not only are they now, is there new royalties that they're actually buying going to go into gold more so than silver. There was one, I believe it was the San Dimas mine, that they switched from a silver royalty to a gold mine, which is a very active choice. So, but Wheaton Precious Metals still actually is by far the biggest silver streamer, and actually in the silver report, there's there is a chart of just how the silver streaming industry is still dominated by Wheaton Precious Metals. Also, I'll say that, like, look, my cost basis on these stocks is not here, so I don't want someone to like buy the stock because they listen to this podcast, and then it goes down 10%, and then they get mad. Like these things are quite overheated. I'd say actually these are probably the most overheated of everything I own, and that like includes Nvidia, to be honest.
Wow. So you think that the precious metals bull market has gone too far, but AI has not?
I'm just on a very, that's just my sense on a very short term basis. I think that the midterm, let's say 1 to 2 year view of AI capex, I have more clarity there. Whereas like the Chinese institutional investors could stop buying gold tomorrow. There could be a discovery of, a huge amount of silver in Antarctica. Then, President Trump convinces Europe to be less environmentalist and to mine Antarctica for silver. And then, there literally is silver paving our roads. So I don't know, but I think my positioning kind of speaks for itself.
Understood.
Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview. So that's my view, Max. And I think with this podcast, I kind of wanted to get the bullish views and arguments in the beginning, and then we'll get more bearish arguments as well. I've got a few things I could talk about credit that are not looking so good. But what are you seeing, Max? Not even just a bearish view on the overall market, but even if we are in a bull market, how are you seeing ways to express bearish positions as a good hedge? In other words, even if the S&P hits 7,000 in a few months or a year, positions that are good shorts and good hedges that actually could make sense.
Yeah, I mean, I have always liked to follow people who are smarter than me. In the shorting world, a lot of times that is activist short sellers. So new position recently was an insurance company called Slide, which there was a short report that came out. One of the interesting things somebody noted was, pretty soon after the short report, we saw up volume of around like $80 million when the typical volume is much, much lower than that. And the company just happened to have a $75 million buyback authorization. So potentially used their one bullet in the chamber already to prop up the stock. Allegations there are essentially that they're systematically underpaying claims, and so their ratios are just way, way too high. Jack, you actually told me something about the company that when it came listed, you thought it was really interesting because they had bought all of these policies from Florida. So perhaps they bought these really cheap policies, had great looking performance, and to maintain that performance, they've had to essentially underpay their claims. So we will see. That report actually came from the former number 2 of Hindenburg Research. So Nate Anderson of Hindenburg, obviously one of the all-time greats who retired from short selling in the last year. Things that don't happen at the bottom. And so, that's just something that I always like to follow. With these short reports, it's really important. I mean, these stocks are battleground stocks. They are super volatile around the reports. So, and also a lot of times around the reports, the cost to borrow can go up a lot as people pile in on the short. So I would just caution that anybody who is following short sellers, you should pick your spots. Pick your spots carefully when you're trying to short them. Don't just like jump in right after report. But just overall, like, you just generally do not end up on a short seller's radar because you're like a great company. Most of the time, there are obvious examples like Tesla that it just like keeps on going forever, or even like Wirecard, the classic one where it just went for years and years and years before the short sellers were eventually proven right. So this isn't something where you can be stubborn and stick around or whatever. So that's a new one. And then also one from a friend on Twitter. So he's at Ben Shooter, and he really likes to follow dividend kills. So these are companies that are paying dividends that the dividend is just not sustainable anymore. So he sent me one and he said, I think this one is imminent. And I took a dive into it and I really, really liked what I saw. So it's Smith & Wesson. I think everybody is familiar with Smith & Wesson, the gun maker, sort of an iconic brand in gun making. And if you go back and you look at the company and when they started paying a dividend, it makes a lot of sense because in the COVID years after some of the protests and riots in the wake of George Floyd's killing, people were really concerned that there was going to be violence in this country, and as well that potentially the political winds were shifting, and it might mean that gun rights were going to be under attack. And so there were a ton of people that rushed out and bought guns. And so if you look at their revenues just over time, you just see this huge boost in revenue in basically in that period. Well, the company decided to start paying a dividend as those revenues went up and as well as their profits went up. Like if you look at net income to dividends, you start to see just like this huge like bump on the chart, and that corresponds with when they started paying dividends. Well, that period is over, right? That has not really changed, and it speaks somewhat to the politics of the time. So right now we have a Republican-controlled executive. We have a Republican-controlled judiciary. We have a Republican-controlled Congress. And so there are concerns. There is rising violence. Like I'm not trying to say that violence is over in this country. In fact, there's plenty of violence going on with the shooting of Charlie Kirk, some of the mass shootings that have gone on. So violence has gone nowhere. But at the same time, there's just not the concern that people's guns are going to be taken away. And we're just not seeing that show up actually in the earnings. So it was really interesting. Obviously, this came out. I got sent this and I put on a short via puts. And then, the tragic shooting of Charlie Kirk happened and the stock rallied. These stocks do tend to rally around violence. So if you are looking to short a gun maker, be aware that if a shooting happens, a big public shooting like that, there's a good chance that these things are going to rally. But it just isn't necessarily playing out. Now, we don't have the numbers, but one of the interesting things about guns is we do have the national background checks, and they actually report that daily. So if you look at the FBI's background check numbers, you can see, or it's the NICS firearm background checks, they have it down to the day, every single background check. So I'm looking at it through September 30th, and you just don't really see like a huge spike. And in fact, background checks year over year compared to 2024 are down about 10%. If you look at them compared to that period where Smith & Wesson was really, really over earning, they're down a ton from there. So in the actual fundamentals of are people rushing out to go buy guns as a result of these shootings, you're just not quite seeing that. But look, just because a business is in decline, as you said, we talked about it earlier with QuantumScape, and they just had so much cash. You really have to say, when is the rubber going to hit the road that they're going to have to do something? And so when you look at Smith and Wesson, I have a chart here that's got their net income versus their cash versus their dividends. And so on the net income chart, you can see that their net income on a quarterly basis just turned negative. They only have by a couple $1,000,000 in the last quarter. They're paying out quarterly about $5.9 million in dividends, and they only have $18 million in cash.
On top of that, they have a buyback going on, and they have some interest expense from debt. So I don't know whether it's going to be they kill the buyback. I don't know whether it's going to be they kill the dividend. That's the bigger one of all of these. But they are running out of cash. More people are not rushing out to buy guns, and they're not making any money. And so I think there is a good chance that they're going to kill this dividend sometime in the near future. And when that happens, one, it's just a business in decline. So it's a fundamental short from the business being in decline. And on top of that, a reason why many people might own it being the dividend that it pays, which I believe the ratio is pretty high, or it's like 5-6%, which as rates are going down, those dividends are going to start to be more attractive to people. So that's one I'm looking at. And yeah, just going to like the most basic metric, which is just the payout ratio. The payout ratio is up to, if you look at it on the last 12 months, is up over 193% as of the last quarter. So they're paying out just a ton of money relative to what they're making. And so we actually, Jack, you and I, we took a look at some of the other companies that have these high payout ratios. And when we ran the screen, we got a ton of REITs, which we looked into it. And so REITs have to pay out 90% of their income. So they're always going to have an extremely high payout ratio. And then you have the companies that are, or the REITs like that are not making money, or that are making very little money, and they have to compete with all the other REITs that are making money. And so you can have payout ratios, like we saw payout ratios as high as like 500%.
Right, but those are real estate companies where they're getting rent every single month. So, again, a lot of these charts, or almost all these charts, I think, Max, we're going to use with our research partner Fiscal. And so if you exclude all the real estate investment trust, all the industries, you get Smith & Wesson has the highest payout ratio of any company that's not a REIT, over $100 million. And we also put a filter on is that the revenue growth over the past 5 years has been declining, which it has. So it's Digital Bridge, Bassett Furniture Industry, and Navient Corporation. All of those companies have a lot of cash. So Smith & Wesson really is, I think, the company that has the highest payout ratio of a company that has revenue declining, that's not a REIT, that doesn't have a lot of cash. So, as a short, I don't know if I'm going to join you, Max, in your short, but we talk shorts. I say my longs, my shorts. You say your longs, your shorts, and sometimes you like my ideas. Sometimes I like your ideas. Sometimes I don't like your ideas. I like this idea a lot. So I think it's very original, and also I could see the potential for this short working in a continued bull market, which I think is what investors may be looking for.
Yeah, and I will say it's not a huge company. Like I believe it's a sub-billion-dollar company in market cap. So if you are a larger investor, you are a professional investor, it might not work for you. And obviously you're going to have to, in the meantime, while they're paying that dividend, when you're short it, you're going to have to pay out the dividend, which is never fun. And as we said, like political violence in this country is on the rise, and these stocks, whether it plays out in the fundamentals or not, like do rally when that happens. So obviously it's never fun to have a horrible event like that happen. It's especially not fun when it hurts your portfolio, as well as like the tragic loss of life that can happen around some of this stuff. So just important to clarify. But there are things on the other side. So one of the people that I've had on other people's money, the guys at Stoic Point are actually playing a name related to this trend. It's a company called Evolve Technologies, ticker is EVLV. It's not a profitable company right now, but they make some of the most advanced detection devices for detecting weapons. So I think we've all been through like the traditional metal detectors that go off if you like have a belt on or something like that. Those are just not efficient for, let's say we got to get, the playoffs are going on. We got to get 50,000 people inside a Yankee Stadium in 30 minutes, right? You can't have everybody taking their belts and their shoes off to get into the stadium, but obviously nobody wants, a horrific event to happen. So this company is making, sort of more advanced devices that are trying to detect weapons, specifically looking at weapons. And they're it's sort of a two-horse market in that. Evolve is definitely the more expensive product, the most advanced product in the space. but it's certainly not the type of thing that if you are the purchasing manager in charge of protecting the security of large crowds of people, you want to be explaining why you picked the cheaper option. So I'm not necessarily concerned about that. So we'll see, how whether they can turn on the profitability spigot. We'll see how long this trend, this negative trend, continues here in the United States and maybe abroad. But it's just interesting to get into some of these gun and gun violence related names at these points in time.
Yeah, and I just looking at Smith& Wesson's profit margin and its net income over time, it just doesn't seem like a very high quality company. It seems cyclical, and as many people know, tons of guns in the country, yet they're not even making money, even in this extremely high gun society. So compare that to many high quality stocks like MSCI, which I don't own, or Mastercard, which I do own, or other companies like I think Costco is a little overrated and overvalued, overhyped. But Costco is many people talk about it as this great business. Like Smith& Wesson is not a one of those business. If other people, if they're looking for potential long exposure to political unrest, let's call it. One name I know through Citrini is Apogee Enterprises, which makes glass and bulletproof glass. I don't have a position, but it is a PE of 19, profitable company, and probably people will be buying a glass and bulletproof glass if there's a political unrest. I also don't have a position in Evolve, but it does look interesting, and it does have warrants, which is also, if you're looking for a convex play, that is a potential. Max, because I mentioned Citrini, I just want to go back to this data center build out. Citrini's most recent piece is really excellent, and we can link in it. I mean, Max, these data centers that are being built all around the country as well as the world, they are, in many instances, compared to comparable to the size of Manhattan, or 25% the size of Manhattan. Like this metadata site is probably, I'm just looking at it now, maybe 5 times bigger than Central Park. There's a data center at the Stargate facility that is basically all of downtown Manhattan. Like these things are massive. So for people who are saying that this whole thing is a bubble, like in the long term, they could be right. But these facilities are being built right now, and the revenues and net income and profits from those on the Capex buildout side are going to be seen next quarter and next year. Now, the question of return on invested capital and whether Microsoft and Meta and Google and other companies are going to be making money from these, that is an open question. But I think that even though the free cash flow for Meta and for Microsoft expectations next year have been going down, because free cash flow is just operating cash flow minus how much you invest, and the investment is huge. So free cash flow expectations for those two companies have gone down. I think profits are going to go up. The earliest that I think those profits could turn the other way, I think, is 2027 at the earliest. And actually, like if you just look at, I made a chart, we can put it up with Google and Apple and Meta. Like their earnings went down in 2022. So I think, to see a real bear market of, a 20, 30, 40% decline, I think typically you got to see number one, the narrative change, or number two, the actual earnings to go down. In 2022, we had both. So even though revenues continue to go up, they were spending just so much money. I think that a lot of these Mag 7 companies and even the hyperscalers, even the spenders who are buying from NVIDIA, I think their earnings are probably going to go up next year. And maybe they'll turn in 2027, but this is a question of timing. And timing is the market, and that is my view. Max, I do want to talk about the Fed a little bit. I do think, I guess, a short-term risk could be the interest rate market is too dovish. I was just looking at the Fed funds being priced in right now, and there's an 85% chance of 2 more cuts in the 2 subsequent meetings this year. That to me seems a little high. So that's 1 cut in October and 1 cut in December. Interestingly, Max, 9 of the 19 dots on the September dot plot showed interest rates being higher than 3.6%, and that is, there's an 85% chance that there's 2 more cuts to from 4.1% to 3.6%. I think that maybe instead of an 85% chance, maybe it's a 65% chance or a 70% chance. I don't trade interest rates, but I think that the market might be a little bit overpricing short-term dovishness from the Fed. I mean, obviously, we're not going to get any hikes, but we had 3 Fed speakers today. Jefferson, who is a voting member, he kind of expressed some pretty neutral commentary, so neither direction. Lori Logan, who is an intellectual heavyweight, no doubt, but she's a non-voting member on the FOMC. She said her comments were quite hawkish, but again, she's a non-voting member, so you could argue that they don't have really any staying power and sticking power. And then John Williams, who runs the New York Fed, who's a permanent voting on the FOMC, his views were neither hawkish nor dovish, but he talked about independence. I think he said the word Federal Reserve independence 4 or 5 times, and in a context, Max, where many people believe that the Federal Reserve will cave to the White House and Trump, or already has caved to Trump. In that context, I think talking about the importance of central bank independence is kind of already a modestly hawkish action. So I think that there could be a chance that the Fed is not as hawkish, not as dovish as the market is pricing. But again, who knows?
Yeah, but I mean, wouldn't you say that stands to say, well, we're going to be more hawkish because we can't be viewed as you are letting the politics influence your decision then, even if it's a counter position to what is expected of you.
How so? No, I think just talking. How so? What do you mean?
Well, if you are saying that they want to take a stand for central bank independence, like there's a difference between taking a stand for central bank independence, saying we can do what we want, and doing what the data tells you, right?
Yeah, I think that, Max, there are people who want the Fed to cave. I think the president is one of those people. And I think the Fed says, no, we're going to follow the data. What you're suggesting is the Federal Reserve is going to they're going to intentionally do something that the president doesn't want, even if it's the bad decision, according to the data. That I don't think is something that they're considering, although you could be right.
Yeah, well, look, I mean, it's interesting just in the context of like taking a step back even further to say what's going to happen with this bull market. Like there's reports of stimulus checks coming out again. Inflation is still not at target. We are cutting rates and you're bearish. Right? Yeah. Like, come on, guys. I don't know what's going on here.
Yes, I think you're completely right, Max. First of all, just talking to the audience here, like, let us know what you think of this episode. Do you think this episode was good? Did you think this episode was bad? Do you think it's not? It's bad, but it's better than the ones we've been doing? Because I have interviewed a lot of investors. I think I know how to create a compelling content with someone interviewing someone else, but that is a very different skill from talking with my business partner and us supplying the analysis. So we are.
You can
This
call
is
me
an
your
ongoing
friend,
process.
Jack. You can call me your friend.
Yeah. Okay. Yeah. But talking with my friend. Yeah. Talking with my buddy. And that's different. So just let us know. We're not saying that we have the answer. So if there's something you really love in this episode, let us know. We'll do more of it. Something you hate, let us know. We'll cut down on that in the future. And also, Max, because we now have this new Spotify tool, and we can do it on YouTube too. We can ask the audience: do you think the S&P is going to be higher or lower on December 31st or January 1st by the end of the new year? And likewise for gold. The price of gold is 39.12. Do you think it's going to be higher or lower at the end of the year? And S&P, it's currently 6,690. Do you think it's going to be higher or lower at the end of the year? So people, Max,
can we put one in
our
for
answers.
Can we put one in for gold versus S&P outperformance too?
Sure, we can do that. Yeah.
All right, I'm interested to see that too.
Sure. So what's your answer to those 3 questions, Max?
I think S&P higher. I think gold higher. I think S&P outperforms.
I think S&P higher, gold higher. I think S&P outperforms as well. Max, I'm getting a little. See, this is. I'm uncomfortably bullish. Like maybe I should do the George Costanza thing and say, because I'm bullish, I actually should just buy puts. I did buy some puts the other day in like late September, but I sold them at a modest loss just because some news flow I was worried about, but then the market went up. And I'd say, Max, it does feel uncomfortable. The market is going up every single day, even though the market was actually very mildly down, basically flat today. And in my personal portfolio, it's like I think it would be healthier if there were more down days. It's getting a little uncomfortable at this point, and I think that yeah, maybe I'm complacent, Max. Maybe I'm too bullish because I've been there's been times my natural instinct, and I think a lot of people have this, Max, is to if you own something and it goes up, you sell, you trim, and I've done that many times, and generally I found I've regretted it. And so this time around, I'm actually I buy something, own something, it goes up, I hold it, or in other instances, I actually buy more. So I have been buying more. But the question also is your cash position because if you buy something and it goes up, yes, you make money, but you don't have any change in cash other than dividends. So you really do have to go sell. So I don't know, Max. Maybe my fervent, ferocious bullishness should be a contra signal to our audience today and to you and to me. And maybe I should do the George Costanza and buy puts.
Yeah, I mean, I just on the gold front, I just think 4,000 is just a nice number. I just think it's a
Yeah.
nice number that we're going to see. And for the S&P 500, it's just like some of the speculative stuff has really been going, but I mean the market has really been led by the large cap names, and then we have seen this the small caps kind of catch up, and that's really what we've been seeing over the last month or so is the small caps catching up. And so if I were to be bearish on any particular thing, if I wanted to express a bearish view, I might be like long the large cap stocks, continue see them sort of like resume their leadership, and short the small caps.
Yeah, I know S&P has been outperforming. Yeah. So I guess, Max, our previous when we did this 2 weeks ago, we talked about small cap season, and it actually has been small cap season. Like the biggest ralliers have been small caps, the most high beta small cap names. But actually, the IWM is actually just like maybe up 1%. So or the S&P is up more, I think. So I actually think that our small cap bullishness was somewhat unfounded. And yeah, the Russell is a tough index because it has all of the companies that have just failed to become mid and large cap over the past 40 years.
Yeah, I mean, if I just look at it on a 6-month basis or on a year-to-date basis, the peak in the S&P 500 to the Russell was at the beginning of August. So, it was, I don't know when the last time we put out one of these episodes was. It was pretty close, but we haven't seen a big reversal back up at all. Like, we're definitely still looking, and not that I am a technical guy, but, it certainly does not look like we're breaking up back towards that that high again. But if I were to, I have heard about the return of small caps many times, and if you are right about the market being overly dovish, which certainly helps the small caps, that's something that we've been talking about, or at least that's the current narrative, is that the small caps are helped by the reduction of rates. And if we're all overly dovish here, I think there's a good chance we get that sort of snap back. So that might be the trade to express for bearishness.
Yes, and also, Max, very low conviction view, but if you and I are bullish on US stocks and you and I are bullish on gold, it kind of follows that we probably also should be bullish on Bitcoin as well. Now, I'm not making a huge call of Bitcoin to $1 million, but Bitcoin historically has been quite correlated with S&P 500 and gold. So often things rhyme, but correlations do change. Like who would have thought that gold and the U.S. stock market could have had such a ferocious rally together? Often, gold rallies at the when the S&P market isn't doing very well. Speaking of coins, Max, you told me that President Trump is releasing a $1 coin. Is this true?
I just saw reports of it today that there was going to be a Trump coin. I cannot think of in my lifetime or in the history of the United States. I mean, maybe at the early days because there wasn't anybody else to put on the coins. But I think that they announced a $1 coin. Treasury shares draft design for America's 250th anniversary. It's got Trump's head on the front. It says, "In God We Trust, 1776 to 2026, 250 years." And then on the back, we've got Trump with the fist in the air, reminiscent of the imagery after he got shot on the campaign trail and that fight, fight, fight slogan that he really picked up after that, that I think is what he said right after the shooting occurred. So I don't know. I am a believer in signals, and to me that is just very bullish.
Yeah, I mean, Trump ordering the minting of his own coin with his face on the coin as the US president. That to me does not seem like the actions of a man who wants to tighten financial conditions.
Yes, that is what I mean. That is what I mean. I think he wants rates at 1%. He's with the rate cutting cycle has already started, and he's still harping on too late, Powell. We're talking about stimulus checks again after we've seen what happens with the stimulus checks, and we're minting coins with living, sitting presidents' faces on them. Not much to say.
Yeah, and I'll, Max, I promised the audience some bearish arguments, so I'll supply them as we approach a close. Which is there have been several high-profile, multi-billion-dollar bankruptcies in the non-banking world, outside of the banking system, even though the banking system did make some loans. So Tricolor, a subprime auto lender in Texas that made loans to subprime credit, a lot of whom are illegal immigrants, some of whom have been deported or left the country. Echoes of 2007 and 2008 in there, perhaps. That went bankrupt. Fifth Third, the bank of your homeland, Max, in Cincinnati, you lost $100 or $200 million in that. Not something you see often. JP Morgan also, I think, tied up in that. And then also First Brands and an auto parts supplier, a lot, multiple, perhaps over $10 billion of credit there. Just some really quite foul stuff that does not accord with high yield spreads of 2.5%, even though I guess you could argue that all of the risky loans have moved outside of the high yield market into the non-bank private credit sector. But, as my most recent guest, Patrick Parrott-Green, argued, like, private credit is kind of pirate credit. So one potential short, I saw, again, Citrini talk about this, is shorting some private credit names. And in particular, he mentioned Blue Owl, which is actually financing some data centers. So a lot of, one reason to be bullish on data centers is that a lot of the spending on them is coming from the best capitalized, most profitable companies in history, Google, Microsoft, et cetera. But actually, some of these companies are beginning to turn to debt financing, and actually not familiar with the mechanics, but like Blue Owl is making some of these financing. So Citrini I saw him on Twitter exploring a potential short there. I also know Clouseau on Twitter. He is a great person who actually, he shares pretty similar taste in what we invest in Chinese fintechs and insurance companies and stuff. So I like Clouseau a lot. He tweeted that actually today, and I believe actually earlier as well, the private credit, basically business development companies that make loans, and this business has been going on for 20 years. They've had a pretty bad day. So some of these stocks are down as much as 2% or 2.55% for Trinity Capital. That is quite a large move for a basically a credit product. So there's potential signs of worries there. And also, Max, again, I don't, oh, Jack is so bullish. He's so bullish on the stock market. But like, we live in a relative world. Stocks are expensive relative to cash and relative to bonds. But treasury bonds by themselves are expensive relative to cash. If you look at term premium, term premium is kind of a fake concept, but it's like the curve is somewhat, the curve is not very steep. Let's just put it that way. But credit is just so expensive. Like it's so cheap for companies, the issuers, but to own credit, like the high yield spreads at 2.6%, it's like, why not just instead of owning 100% high yield, just own like a little bit of stocks and then own some cash, because at least you get that upside of like reinvesting earnings and stuff. Your thing is your returns aren't capped, and then you can just own cash, which actually is a great free option, an option that pays you money if things go wrong. Whereas if there's a huge recession, maybe these credit things probably won't end up well. So yeah, I'm not particularly bullish on credit. I think credit has a pretty negatively convex risk reward, as it often does. So I'd say stocks and cash over credit. But what do I know?
All right, Jack. Well, why don't we leave it right there? I'd like to remind everybody that we have a special discount for anybody on any fiscal plan. You can get 15% off on any of the paid fiscal plans, whether you're an individual investor who wants to do one of the lower levels, or you're a professional investor who wants access to their data. You can get that at the link in the description. Jack, thank you so much. Have a great weekend.
Great to be here. Thank you, everyone, for listening.
Thank you. Just close this door.